All right, let's dive right in. Today, we're going to demystify one of the most powerful and honestly purest ways to look at the markets, price action. It's all about learning how to read the market story directly from the chart without all the clutter. So let me just ask you this right off the bat. Is it actually possible to read the market and maybe even get a hint of where it's going next without a single solitary indicator on your screen? Well, the answer is a resounding yes, and that's the core idea we're going to break down today.
You see, here's the crucial difference. Most of the indicators people use are lagging. It's like trying to drive a car by looking only in the rearview mirror. I mean, sure, it tells you where you've been, but it's not great for seeing the turn up ahead. Price action, on the other hand, is all about looking through the windshield. It's about what's happening on the road right now.
Probably the best way to wrap your head around this is to think of the market as having its own language. And if you want to become fluent, you really only need to learn two things: its alphabet and its geography.
So first up, let's talk geography. And we'll start with support. Just think of it like a price floor. It's an area on the chart where, in the past, we've seen buyers step in and say, nope, the price is not going any lower. It's a level the market has defended before, and that's a huge clue.
The psychology here is everything. I mean, why does the price bounce there? It's because when it gets back down to that known support level, traders and investors start to see it as cheap. It's a bargain. And that perception is what triggers a whole new wave of buying, pushing the price right back up. You're literally watching human psychology play out.
And if support is the floor, you've probably already guessed what resistance is. It's the ceiling. It's the complete opposite. An area where sellers have historically jumped in and overwhelmed the buyers, shoving the price back down. Think of it as a price point the market just can't seem to break above. And yep, the psychology is just the flip side of the coin. As price gets close to that resistance level, the collective thinking shifts. Now the asset is seen as expensive. So what happens? Buyers start cashing in their profits, and new sellers enter the game, creating that downward pressure. Okay, so if support and resistance are the key landmarks on our map, then the candlesticks, well, they're the alphabet of this language. Every single candle on your chart tells a story. It's a mini-narrative of the battle between buyers and sellers in a specific time frame. And the shape and size of that candle tells you who won.
Let's just focus on two key words for now. First, you've got the momentum candle. It's got that big, full body, which is basically a signal of a knockout punch, a decisive victory for either the buyers or the sellers. But then you have the rejection candle. That long wick tells a very different story. It shows one side tried to advance, but they got aggressively pushed back. That wick is the evidence of a failed attack.